Okay, good morning. Today we're going to be finishing up Chapter 12. And before we do, just a couple, I'll talk about the exam every day until now, until finals week. Exam 3 is available Sunday, December 7th through Tuesday. You have to finish it by 6 p.m. on Tuesday. Sections 3, 7, and 8. Schedule with Proctor U soon. If you do not see a time, if everything's filled up, for example, Sunday's filled up, call them on the phone, because sometimes they can do things with their computers when you talk to them on the phone that you can't do just with the interface on the internet. And there is, just a reminder, a 10-point bonus if you complete the exam by 6 p.m. Sunday. That's 6 p.m. Eastern Time, and you have to submit it by 6 p.m. The computer lab will be open on Sunday from 9 a.m. to 6 p.m. From 9 a.m. to noon, it's just my classes, so there should be plenty of seats. It really isn't, it should be steady the whole day. It should be pretty full the whole day if the pass is any indication, but you should not, there's always a possibility of lines, but you should not have to wait more than, I would think, 5 to 10 minutes, but we'll see how Sunday goes. In the past, about half my class has taken it Sunday. So do plan on that if you can. We have a question in Learning Catalytics now. A lot of people didn't get it right on Monday, so we'll try it again. This question is going to stay open until I do the next one, which could be anytime. I guess I don't know when the next one's queued up. But the purchase of treasury stock by corporation increases total assets and stockholders' equity. Okay, good. A lot of people are getting it right, so that's good. And again, this question is going to stay open for a little while, so that is false. When we purchase treasury stock, cash is going down and stockholders' equity is going down. Treasury stock is our own stock we're buying back. Okay, do this Saturday, homework chapter 11. If you're in section 3, you also have a quiz. And we are continuing the income statement today. If you're just joining us, make sure to sign into Learning Catalytics. There is a question open out there for just a little bit. I'm not sure when. Okay, remember that this chapter, we are not doing Learning Objectives 2 and 3. Learning Objectives 2 and 3 refer to foreign currency, gains and losses, and other items on the income statement. You might see them on the income statement, but you don't need to be able to compute a foreign currency translation gain or loss. Okay. We did quality of earnings on Monday, but today what we're going to do is we're going to talk about management versus auditor responsibilities. The question that we put up is not closing for a little bit. Okay, yes. Okay, so when we have financial statements, there's two parties involved with financial statements. There's management of the company and there's the auditors. The auditors are an outside firm that comes in and tests everything to see, does it test everything, does samples of tests to make sure, as much as they can, that the results that the company is publishing are legitimate, that they do reflect what's going on. So you have management of the company. They're the ones that direct the accounting department. They're the ones that authorize transactions, et cetera, et cetera. So management is responsible for the financial statements. The auditors are responsible for testing those financial statements to make sure they comply with U.S. GAAP or IFRS. Now, auditors, there are there's big four that we refer to on a global basis, the big four accounting firms. And those are names like PwC, PricewaterhouseCoopers, Deloitte, Ernst, and KPMG. Okay, so if you ever hear those names, those are the big four. And they're known as the big four because they are the largest four firms, and they are around the world. They're global. On my study abroad trip, we visited Deloitte, we visited Ernst, we visited KPMG in Paris and in London. And then right after the big four are another couple of firms that are huge, and one of those is Grant Thornton. And Grant Thornton has a big presence here on campus, and they are another firm that's huge, mammoth, and we visited them in Scotland and London, and Haley is actually going to work for Grant Thornton. So you hear these names, and they are big firms, and these are these independent firms that come into a company and test transactions, test their policies and procedures for how they're working to be able to form an opinion. I, as an investor, rely heavily on their opinion, on the auditor's opinion. I want the auditor to come in and say everything looks okay. If the auditor weren't coming in, I would be relying on just the company's representation that everything's okay, and we know that sometimes people don't have honorable goals, or they just make mistakes. So the auditors form a real important function. Now, management. So we have auditors and we have management. Management's responsibility is to set up an internal control system. So management's responsible for the internal control system. Internal control system is where we separate duties, that the person collecting the cash is separate from the person reconciling the bank statement. So you just can't collect cash and hide it. Or another thing that we want to separate in our internal control is the person buying parts and authorizing payment for the parts is not the same person. That reminds me of a story. Smuckers. Smuckers, they're local. So Smuckers has an airplane hangar at the Akron-Canton Airport, and they have a jet. And they have a chief airplane mechanic or something like that. And they had this airplane mechanic, and he worked there for 16 years. Last year, and his duties were to maintain the jet. So he kind of worked at the Akron-Canton Airport. I don't know how much interaction he had with the Worcester main office, but he worked there, and he was chief mechanic. Well, it turns out that over the 16 years, what he did is he set up a fictitious company, and it was Aircraft Parts Inc. or something like that. And so he set up this fictitious company and had he had a P.O. box in Greentown, and so this is where he did the nice invoices on his computer, and he would bill Smuckers for parts and that they didn't get, and for work that he himself did. But because he's the chief mechanic and he built up a series of trusts, he was allowed to authorize anything up to $10,000. So most of these invoices were smaller, $8,000, $5,000. So he'd bill Smuckers, and then he'd authorize it and send the invoice off to accounts payable. So then there were a few times where he would bill this fictitious company would bill Smuckers for more than $10,000, and so his supervisor would have to okay the invoice, and his supervisor, because he'd known him for so long, he's a long-time employee, well-trusted, would okay it too. So over the course of 16 years, this guy billed Smuckers and collected $4.1 million over the time. And the problem, the breakdown here was internal control. You have a person who is ordering and purchasing all by themselves, and you have that same person receiving the stuff. So that's the person that's observing the work and saying, oh, we got these parts. So you have that person ordering them, authorizing them, and then you have the same person authorizing the payment. And that's a huge breakdown in internal control. And what happened is $4.1 million later. I guess what happened, how he got caught, and they haven't released all the details because the FBI charged him, and now it's working its way through the court system. But I guess apparently there were three checks that Smuckers had made out to this fictitious company that were not cashed. So they're not saying why they weren't cashed. That seems to be a breakdown. But so the accounts payable person went to this chief mechanic and said, hey, this company isn't cashing these checks. And the guy says, well, let me take care of it. I'll contact them. So then he contacted one of their real vendors because there must have been some problem with cashing these checks. So he contacted one of their real vendors and said, hey, I've got a problem. Can you help me out here? We are going to reissue these 3 checks to you, and just say you bought this fictitious company, apparently from reading this. And this is what they're not saying yet, so I'm assuming this will come out when it winds its way through the court system. Then I think the company that he approached to help him collude on this, I think something went wrong there. And so they actually did catch him, and he's been charged. But that's an example of an internal control that has gone bad. Now Smuckers, they've disclosed that this has happened, but they also say that they expect him to be prosecuted, etc. But they also say that this is immaterial to them. $4.1 million, even though it sounds like a lot to us, is not going to have a huge impact on Smuckers. So it's an unfortunate incident, but they'll recover from it. The other thing is you have an airplane mechanic who over the course of 16 years was able to purchase 2 planes, some really nice cars, and make payments on a house. So his lifestyle did not match his salary, so that's another red flag. Anyways, so management is responsible for internal controls, setting up internal control systems, policies that make sure the same person that is purchasing stuff isn't the person authorizing it or receiving stuff. Once you say you can receive stuff and okay invoices, you can do whatever you want, right? Because you get the stuff and you can say, yeah, we got that. In his case, he performed the services, or there were no parts, but he said there were, so they could get paid. So, okay, so that's management's responsibility, has responsibility for internal control. And management has to say that it's conducted an assessment of its own internal control and that it seems to be effective. Now the controls themselves are audited by the auditors. The auditors come in to make sure the controls are working. The auditors report. So we have these auditing firms, CPAs. They come in and they have to examine the financial statements of publicly traded companies. They can also you can have audits of private companies. Like Michael Dell, he just purchased Dell back. Dell was a public corporation for many years. Well, Michael Dell just took it private again. I would suspect it's such a huge corporation, he is still going to have an audit, because even as a private owner, it gives you comfort that things are working as they should. But you're required if you're publicly traded. And the auditors determine if the statements comply with GAAP. They issue a report on the financial statements and internal controls, and we're going to see those today. Okay. Now I'm going to talk about Smuckers now. It's just this coincidence that they just had the incident of fraud. But what I'm going to do now, you do not need these statements. This is nothing you need to memorize. I just want to show some examples of these reports. And if you're interested, you can actually Google Smuckers annual report and go to Smuckers website. And they have, if you want an annual report for any company, you can go to Investor Relations on their website, and they will have their annual report there. So anyway, Smuckers, all the slides to come from Smuckers' most recent annual return. This is the 2014 annual report. What I've done here is I have, there's 3 letters in Smuckers' report, and I want to talk about those. Now what I've done is I've put the whole letter here, which no one can read, but I wanted to show you the context, because I'm going to pull paragraphs out and we'll talk about the paragraphs. So this first one is the report of independent registered public accounting firm on internal control over financial reporting. So Smuckers has 3 letters that go with it that are in its annual report. This first one is their report on internal control over financial reporting. So there's this letter, and it has 6 paragraphs. It's very much boilerplate. When you read these reports, there is precise language used. Okay, so this is their report. You can see the report is made out, you can kind of see at the top in bold. It's made out to the board of directors and shareholders. So the reports the letters are addressed to the board of directors and shareholders. And down at the bottom, it will be signed by the accounting firm. This one is Ernst & Young. Okay, so they're one of the big 4. So that's Smuckers' auditor. Okay, so So the report on internal control, we're not going to go into each of those paragraphs on this one. We'll do the next two reports. But the report on internal control, basically Ernst & Young is saying they examined internal control and they deemed it to be effective, that it's in place, it's working, and it's effective at doing what it should do. So that's one report that the auditors make. Auditors are not responsible for designing internal controls. They're responsible for testing the system, internal control system that management has put in place. Okay, now next up is the report of the auditor on the financial statements. So the auditors did a report on internal controls, and now they do a report on the financial statements. And this one, very, very much, you read one, it's going to look very similar to the next companies and the next companies. And this one, okay, again, it's made to the board of directors and shareholders of Smuckers. Okay, and this one we are going to go through each of the 4 paragraphs. Again, you don't need to memorize this, but I do want to show you what these reports show. Okay, audit report, paragraph 1. This is from Ernst & Young. So Ernst & Young is saying, in the green sentence, is basically saying what they've audited. They have gone in to these financial years that are presented in these financial statements. You'll see there's 2 years here. They audited 2013 and 14. You can see right now that Smucker's year end ends April 30th. Okay, because you get an audit report at the end of the year. So their year end is April 30th. And so they audited 2 years, and then it tells us which statements they audited. So that's the first sentence, says, what did you do? And then the next sentence, I've put it in red, these financial statements are the responsibility of company's management. That is so key. As a manager at a company, you are responsible for financial statements. Going back to Enron, this was a result of Enron actually. Companies have always been responsible for financial statements. Auditors don't do accounting. Auditors test things. They test to make sure they were done correctly, but they aren't responsible for it. Let's rewind here back to Enron. During Enron imploded because Enron just made up accounting entries. Enron would decide, gee, we need this much money, this is what we're going to book for net income, and let's figure out how we're going to make the entries to make that happen, is basically what they did. They just made things up. They would do a deal and they'd decide how much income they wanted or needed from that, and those are the journal entries they would write over the life of the deal, whether it made any money or not. So it was just really, really terrible what they did. But the CEO, his defense at his trial was, hey, I don't know, I'm not an accountant. I let the accountants do that. It's not my fault. And he actually, it kind of worked as a defense. But as a direct result of Enron, we have a law. It's called Sarbanes-Oxley, or SOX, S-O-X. And in there, there's lots of components. It was a huge impact on accounting and auditing. But one of the components of that is that management is responsible for the financial statements. So it's now law that managers are responsible. So for those of you in this class who are not accounting majors and you look at this stuff and you think, when am I ever going to use this? Well, keep in mind, as you rise in management, even though someone else is doing your accounting, you are ultimately responsible for it. So that's so the audit report states that the financial statements are the responsibility of company's management. And then it says that the auditor's opinion, the responsibility is to express an opinion on the financial statements. Okay, so that's the first paragraph, telling you what they audited and what the responsibility is. And that will be the same for every company. Okay, so now paragraph 2. Paragraph 2 says, gee, we conducted our audits in accordance with the standards of the PCAOB, which is Public Company Accounting Oversight Board. That also came out of Sarbanes-Oxley. So this is also a board that was set up in direct reaction to Enron. So this is the board that watches the auditing companies. Because what happened with Enron too is their auditors had offices at Enron and hung out with the Enron people, and basically were part of the Enron family. So they were no longer independent. So, and no one has oversight over the auditors, so that's why they came up with this PCAOB. Okay, now these standards require that we plan and perform the audit to obtain reasonable assurance, and that's key, reasonable assurance. Having an audit does not guarantee everything is okay. It's reasonable assurance. It would be cost prohibitive to explore every single item. We do testing and sampling, and we can be reasonably assured that it's okay. And then it tells us in the blue, an audit includes examining on a test basis. So they're sampling. They're doing statistically valid samples to form a conclusion. And then, so that's the paragraph about what they did. Okay, now this is the big paragraph. In our opinion, the consolidated financial statements present fairly in all material respects the consolidated financial position. So they got what's known as, and this is such a misnomer, they got an unqualified opinion. An unqualified opinion means that it's not qualified for anything. You know, like you can qualify something, you can say, I like everything except the yellow one. The except the yellow one is a qualifier. You know, it's, your statement's qualified by that. So that's how unqualified is used. Unqualified means there are no exceptions. So as an auditee, you want an unqualified opinion. Okay, so and then it says that they examined this and they conform with U.S. GAAP. Okay, so this is the paragraph we want to see. Okay, and in paragraph 4, it tells us, again, it's referring back to internal control. Paragraph 4 says we've audited this internal control, and then the last in red, there's those words, unqualified opinion. You might want to make a note of that because you're going to see unqualified opinion later. It's in the reading, but unqualified opinion means this is the best report you want. This is the one you want. This one has no exceptions, which is what you want. If you have a qualified report, there's trouble somewhere. Yeah, that comes out the week before the exam. Okay, so now that last report that we looked at was from the auditor saying, here we audited the financial reports. They're in accordance. We did our audit in accordance with our standards, and the financial statements present fairly, etc. Now, this next letter, the third letter we see with the annual report, is the report of management on responsibility for financial reporting. So this is management. This is Smucker's management telling all the users of statement. This is addressed to the shareholders, and it's signed by Richard Smucker, the CEO, and the Senior Vice President and CFO. They're both signing the statement. And what we see in this one is we see management of Smucker Company is responsible. So right off the bat, they're telling us management is responsible. That's a legal law. Management is responsible whether they say it or not, but they include these letters. They are acknowledging they are responsible for the preparation, integrity, accuracy, consistency of the financial statements. The auditors are responsible for testing the statements to make sure they comply with U.S. GAAP. Management is responsible for the accuracy, the preparation, all of that. So management's responsible, bottom line, for those financial statements. And then they say they've prepared it in accordance with U.S. GAAP. Okay, paragraph 2 says we maintain systems of internal accounting controls, and we have an internal audit staff. So they're telling us that we have an internal control department, by the way, is a department of the company, and their responsibility is to kind of run audits throughout the year, testing just like the external auditors do to some extent, but they're also big into testing operational efficiency, making sure policies and procedures are being followed. And the Internal Audit Department does not report to accounting. Internal Audit Department reports to an audit committee that's on the board of directors. So they don't report to anybody else in the corporation. So they're the internal watchdogs, and then we have the external auditors also. But anyways, they're acknowledging they have an internal audit department. And then they say that they hired Ernst & Young to audit the financial statements, and that Smuckers provided all their data to Ernst & Young for the audit. And then paragraph 4 tells us exactly what's going on with that internal audit department. So they have an audit committee comprised of 4 non-employee members of the board of directors. So there's a few employee types on the board of directors, but now they've taken 4 people on the board of directors who have nothing to do with day-to-day operations of Smuckers, and they meet regularly with Ernst & Young to review the work of the internal audit department to make sure that that's going well. There, the audit committee is the one that reviews the independent auditor fees and things like that. And then the director of internal audit department reports directly to the chair of the audit committee. So, so there's lots going on in this letter that management says. They basically are saying we're responsible for everything, and here's what we have set up. Okay, and then management responsibility, that paragraph 5, our best judgment that everything works together to provide reasonable assurance that we're operating according to law and in compliance with highest standards of business ethics. So this is Smuckers management saying, here, we've done everything right, here's what we've done. We have this internal audit department. Okay, so that's Smuckers' 3 letters in your annual report. We're going to do a couple questions now. Okay, so the first question, an audit report is addressed to the board of directors and stockholders of the company. True or false? Surprised you with it? Okay, there's a question in Learning Catalytics right now to be answered. Refresh if you don't see the question. Here, why don't we, well, I'll tell you what, why don't we stop this, let's stop delivery and just redo it. It'll replace it, remember, right? Yeah, okay. It's there now. It should be there now. Answer, we just redelivered it. What? But it works, right? I mean, it's taken them now. Okay. Because that redelivery will replace the first one. Oh yeah, they're coming in now. Yep. Okay, an audit report is addressed to the board of directors and stockholders of the company. True or false? We're going to do 10 more seconds on this one. Okay, and that is true. Our audit report goes to the board of directors and the stockholders of the company. Stockholders and shareholders, interchangeable terms. Okay, next question. It is the independent auditor's responsibility to determine whether the company's financial statements comply with U.S. GAAP. True or false? Okay, it is the independent auditor's responsibility to determine whether the company's financial statements comply with U.S. GAAP. True or false? 10 more seconds. Okay, and that is true. Okay, and so we'll come back to, that's it on questions for right now. We're going to do some in a few minutes. So keeping in the vein of Smuckers at the moment here, I wanted to show you a couple other things in their annual report. So in their annual report, they have the 4 statements. They have their balance sheet, their income statement, their statement of cash flows, and their stockholders' equity. And those are the ones that are audited and that go with the letters. But typically at the beginning of an annual report, they'll take selected numbers out of that and present it. And believe me, the auditors look at this too. There are hours and hours and hours of proofreading that go into preparing this. Attorneys review it very, very careful. This is not just thrown together rapidly. There's lots of laws governing even this. But this is a financial review, and all it does is that it gives you, in a real quick format, some highlights from Smuckers. And what I wanted to show you here, because I know it's small, is I'm going to blow up certain lines. But I wanted to show you the financial review, so if you look at it later. Okay, so right here in the very top it says statements of income. So if I blow that up just a little bit, again, you don't have to memorize these numbers. What I wanted to show you is right now it's presenting 5 years. The earliest year is in the far right, 2010, and then the far left column, 2014, is the current. So what we can do is we can look at Smucker's quality of earnings. Basically, they've done some things for us. They have gross profit as a percent of net sales. That's the third line down. So if I look at that, in 2010 it was 38.8%, 2011 37.3%, but then in 2012 33.4%, so it fell. But then in 2013, 34%, 36% more recent. So we have a case of 5 years ago it was higher, it dipped, and now it's on back on the upward trend. So you'd say, oh, they're going in the right direction. Operating income as a percent of net sales. We started in 2010 with 17, went to 16 the next year, 14 the next year, but then we popped up to 15 and to 16. So it seems like Smuckers experienced a little dip, as did most companies. If you think about what was happening there was a recession in there somewhere, and so they were operating high, they dipped during the recession, and now they're starting to climb back up, which is what we would expect to see. So those are just some highlights. They're showing us, they're showing the analysts some of those measures of earnings quality. So next up, down below, there's share data. And what they're doing here is they're telling you how many shares they have outstanding. They figured their weighted average shares outstanding. And so we look, say for example, 2014, they have 104,332,000 shares outstanding. This is weighted average. They've calculated the number of shares that Smuckers has outstanding any day varies. It can vary. So they calculate a weighted average based on how many days each one. And then right below there, they have weighted average shares outstanding assuming dilution. So this is where they've said, oh, if those numbers are not the same, they've got some convertible instruments out there, and they do. So they have a little bit of convertible, and we know that because the weighted shares outstanding is 104,332. The ones assuming dilution, 104,346. And then right below there, it has the dividends declared per common share. This is kind of interesting. Back in 2010, Smuckers had a dividend of $1.45 a share, 2011 $1.68, 2012 $1.92, all the way to $2.32 today. They have steadily been increasing their dividend. Okay, so Smuckers is returning dividends to shareholders. And then right below that, it shows their net income per share. And we look back in 2010, they had $4.15 per share, $4.06 in 2011, So it fell a little bit, was stable in 2012, and then it climbed to $5 in 2013 and $5.42 in 2014. So Smuckers, when I'm looking at Smuckers, Smuckers looks pretty healthy. Looks like they had a little dip during the recession like many, many companies, but it looks like they've come out of it pretty strong. So there's lots of things you look at, but I just wanted to show you that some of these things we've been looking at in class are on the financial statements. Okay, next one, another example here. Avery Dennison. Avery Dennison, to me, when I think Avery Dennison, I think those labels or the name tags. You go in Office Max and they have Avery Dennison labels. And so that's what I think. That's how they present in my mind. So when I look at their income statement, the reason we're looking at it now is they have income, they have a loss from discontinued operations. Down here at the bottom, okay, I blew it up, but down here, right down here, discontinued operations. That, if I look at their income statement, because I went through yesterday trying to find a company that had discontinued operations, so I came up with Avery Dennison. So they have a loss. So I blew it up and put it in the middle of the screen. They have a loss from discontinued operations. So they had a gain in 2011 and 2012. We know that because it's positive. But 2013, they have a loss from discontinued operations, which means they sold something that was losing money, or they lost money on the discontinuation. And it's presented at the bottom of the statement so that investors don't confuse it as part of ongoing earnings. But what's interesting about this is when I see this, then I'm like, ooh, I wonder what that is. So the first thing you do is you dig into the notes to the financial statements. The notes to the financial statements go through each significant accounting policy and significant event. So when you start looking, Avery Dennison on January 29th, 2013, remember those are 2013 financial statements because they don't have the 2014 ones out yet. But 2013, they entered into an agreement to sell our OCP and DES. So my next question was, what's OCP? OCP is Office and Consumer Products. So you know those labels that I identify with Avery Dennison? They sold that. So Avery Dennison doesn't do the consumer labels anymore. A different company does. And they've actually, the other company that's doing them now has rebranded it as Avery. So they've dropped the Dennison. So it's just Avery labels are no longer owned by Avery Dennison, just like the Limited is no longer owned by Limited Brands, which I think is so weird. But anyways, so it just tells me what happened, that they sold these two divisions and they had this loss on it. So I just wanted to show you an example of a loss on discontinued operations, that it does happen. Okay, another question. So I think we're going to do several questions in a row here now. So another question. The audit report is signed off by corporation's management confirming the audit was completed properly. The audit report, and we could say the audit report is signed by corporation's management confirming the audit was completed properly. True or false? The elaborate tax court, they can help her. It's probably a Java setting or something like that. Okay, the audit report is signed off on by the corporation's management confirming the audit was completed properly. True or false? We've got about 10 seconds left on this one. And again, a lot of this is learning to read carefully, because one word can make all the difference in the world. Okay, this one, surprising many of you, I would think, is I'm frozen. Okay, try it again. Okay, the audit report is signed off by corporation's management. That is false. Management does not sign off on the audit report. The audit report is the report by the independent auditors. If you say all of a sudden management has to sign off on it, no, you don't sign off on your own. You can't say, oh, it was done right. This is auditors sign off on the audit report, not management. An unqualified opinion by the independent auditors indicates the fairness of the company's financial statements and effectiveness of its internal controls. An unqualified opinion, true or false? Okay, an unqualified opinion by the independent auditors indicates the fairness of the company's financial statements and effectiveness of its internal controls. True or false? 10 seconds. Pat, let me close this and I'm going to address your question, Pat, in just a minute. I'm going to make a comment about that. Okay, unqualified opinion by independent auditors indicates the fairness. And that is true. We want an unqualified opinion. That means there's no exceptions. Okay, now there was a question about Pat saying she thought my question meant manager of independent agent. Whenever you see the word management, it refers to the company. We don't refer to management of the internal auditors. Internal auditors have a partner in charge of the audit, and we don't refer to that as management. Whenever you see management, management means of the company. We have management and we have auditors. Those are two different parties. So that's why, Pat. Okay, another question here. Which entity requires companies issuing publicly traded stock to have their financial statements audited by an external auditor? Which entity? Okay, which entity requires companies issuing publicly traded stock to have their financial statements audited by an external auditor? 10 more seconds. That would be the Securities and Exchange Commission, okay, the SEC. Okay, another concept here, so we'll come back to the questions in a minute, but we have another couple little concepts stuck at the end of the chapter. And correcting retained earnings. Let's say a company makes accounting errors. There's been a big one in the news recently, and that would be Hertz. Did you read this? Hertz has massive accounting errors, and they're not sure how it got by the auditors, but there's massive accounting errors. Hertz has to restate. When a company discovers accounting errors from a prior period, let's say they didn't, like in Hertz's case, I believe, they don't have a lot of expense they should have had. So they don't put the expense in this period. So Hertz is now saying their 2012 statements and earlier are wrong. They aren't going to put that expense in 2013. They're going to go back and they're going to put it in retained earnings in 2013, but they have to restate all their prior statements. So they have to, when you find an error in an earlier period, the error goes to retained earnings. It doesn't go to income or expense this period. It goes to retained earnings, and then you have to go back and restate your prior years. And this can be pretty significant, and the stock market is not happy with this. So you'll typically see your earnings take a hit when you do this. But there's massive restatements going on by Hertz right now. And this happens pretty frequently, actually. There's been a lot of errors. So that's officially known as a prior period adjustment. So that is, those are not random words. These are actually the real name of it. Prior period adjustment. This is when we discover revenue or expense has been recorded incorrectly in a prior period. So we go back and adjust retained earnings, and then we restate everything that came before that. Okay, so prior period adjustments. Okay, so thinking about this, we're going to go a little bit further here. A prior period adjustment that corrects income of a prior period requires an entry to what? So if we're going to correct income of a prior period, we're going to require an entry to do what? What do you think that entry might look like? A prior period adjustment that corrects income of a prior period requires an entry to what? And 10 more seconds on this one. Tell Liz is online right now. Liz, bring it in when you see me, and we can also. Retained earnings. So when you would do a prior period adjustment, an easy thing to know, when you do a prior period adjustment, it has to go to retained earnings. Okay, prior period adjustments. So thinking more about those prior period adjustments. So we can adjust for income or expense. Prior period adjustments, A, only decrease retained earnings, only increase retained earnings. We had 9 questions. Can either increase or decrease retained earnings. I don't think we have, but. Or do not affect retained earnings. Fatima, we don't, actually you would be surprised, we don't know how many questions we've had. We don't keep track of questions by that. So, yeah. Approximately 8, but we could be off by 1. Okay, so 10 more seconds on this one. Prior period adjustments, you can make errors in either direction. You can have expense overstated or understated. You can have income you're missing or income you over-recognize. So it can go either way. Okay, earnings per share is the amount of a company's net income per share of its what? Not everyone got this right Monday, so we're going to try it again. Earnings per share is the amount of a company's net income per share of what? Ten more seconds on this one. Ten more seconds. Earnings per share is the amount of a company's net income per share of. And that's outstanding common stock. Okay, another one I've thrown in there. How do you earn the 10-point bonus on the final exam? What do you have to do to get the 10-point bonus on the final exam? Well, I'm glad you're taking advantage of it, Joshua. Okay. 10 more seconds on this. How to earn the 10-point bonus on the final exam. Okay. And the answer is finish the exam by 6 p.m. on Sunday, December 7th. Submit it by 6 p.m. Eastern. Okay, that brings us to the end of what I have for today. So we're going to call it a day. And I guess Chapter 11 will be due this weekend. And we will see you Monday next week.